Justin, thank you very much for joining us today. How are things in Southern California?
They're absolutely gorgeous. It's the best time of year here. It's spectacular.
Yeah, and what is the temperature right now?
About 75 degrees and sunny.
Oh my God, it's warmer in Toronto. We're probably 80 or 85 degrees.
Yeah, we've got a little coastal influence here, so it keeps it pretty comfortable.
So, Justin, we have a lot to discuss, and I want to start with this World Nuclear Fuel Conference that you recently attended in Atlanta. There was many industry leaders there, including a lot of U.S. utilities, and just given the lackluster performance that we've seen here in recent months, I'm kind of curious to hear your thoughts on what the mood was like from the producers versus the utilities.
It was a pretty contrasted mood, I would say, overall. It was quite striking. The mood of the conference, generally speaking, was kind of just comfortable. The U.S. utilities seemed to be, while simultaneously not wanting to chase price, and clearly by the reported volumes in the term market so far this year, 28.5 million pounds year to date. We're halfway through the year almost. That's extremely low in terms of volumes in the term market. So the utilities are not that happy with the terms that are being offered by most of the producers for contracting right now, with relatively high ceilings, and the floors themselves are also pretty high in the negotiations. I mean, these things vary based on the various producers. There's no one type of contract, so the terms in the contracts are all over the place. But generally speaking, the terms that are being asked for by producers are not in line with what utilities are looking for. At the same time, especially in the U.S., utilities are doing extremely well. Electricity prices are up pretty much across the board. The publicly traded U.S. utilities that have exposure, especially to nuclear, have gone up 2 or 3x in the last 12 to 18 months. So they're doing very, very well. And the support for nuclear in the United States is like nothing we've seen since the 1970s. So all of these utilities are very constructive on the future of their nuclear operations. All of them are wanting to build new nuclear, and the environment for nuclear in the United States is incredible. So with all of that said, even though the mood was somewhat boring and somewhat complacent amongst the utilities, there's pretty much consensus amongst the nuclear fuel analysts, the investors, and the producers that we're going to see a much higher pricing environment going forward. So you have the utilities on one side, relatively comfortable, making a lot of money, not happy about the prices, but also decently covered in the near term to the point where they can step back, and that's because they've flexed up on contracts, they pull forward material from Russia, et cetera. And they're 100% focused on waivers right now. So there's nothing else that matters to the U.S. utilities besides these waivers for the Russian ban, which are still unclear on exactly how these are going to be issued, if they're going to be issued, et cetera, et cetera. There's much more issues surrounding that whole story we can get into if you want. But on the other side of things is Jonathan Hinsey from UXC, Treva Klingbeil from Trade Tech. There's a great presentation from Grant Isaac from Cameco. They're all basically saying uranium supply is a problem. It's not going to get better for years. You guys have to step up to the table, sign more contracts. Supply issues are a problem. Treva's entire presentation was about supply risks and the long lead times for developing new discoveries. So the picture has never been better for the growth of nuclear. We're in this period of time where this historically very large move in the price of uranium from $50 a pound to 106 in January, pulling back here. We're trading 85.90 right now. It's very widespread, but these very high prices are something that utilities are still just digesting. And now we've seen 2 pullbacks into the low 80s that have been bought up relatively aggressively. Price pulled back from 90 to 82 something over the course of about a week last week on a few 100,000 pounds traded. As soon as we hit, the 82, 83 level, multiple buyers stepped in much more size on the buy side than was offered on the sell side the previous week. So that low 80s seems to be a floor in the spot market that's been tested twice, and that's extremely constructive. That's a much higher low from the move up from $50. So we continue to consolidate and digest this move. I continue to be very constructive on a considerably higher move at some point later this year.
Justin, you mentioned that there was 28 million pounds contracted so far.
That's the official reported number from UXC, yes.
And how does that compare to this time last year?
Well, last year there were a lot of contracts. There was 55 million pounds done in Q1. I think we were probably 3 or 4x this number at this point last year.
Yeah, so very quiet. Now, you made mention of the fact that Trade Tech and UXC were speaking, and of course, they were quite bullish on the uranium price. But, and I know there was a lot of utilities participating in various discussions and panels. What was the messaging from them?
The messaging from the utilities, they're primarily focused on a number of factors with regards to their actual own operations, and they're not really focused that much on the nuclear fuels market. You know, the biggest concern to them has been conversion and enrichment for the past 2 years, because that's the biggest contribution coming from Russia. So whether or not official sanctions ever actually panned out, and my understanding is the utilities didn't believe this legislation was going to pass. Maybe by some kind of executive order at some point, but they didn't think the actual legislation was going to pass the Senate, especially after this meeting that took place on April 30th. So that's been their primary focus. Their operations, they're operating into an environment where they expect incredibly large rises in demand. And this is brand freaking new. So to give you an idea, in 2021, Dominion put out a 15-year plan, essentially a guidance for the future 15 years of operation. This is 3 years ago. They expected over that 15-year time period to see single-digit increase in demand. This is coming specifically from Dominion. This is not to speak of overall electricity demand in the country, but specifically for Dominion, who operates in Virginia. And Virginia, of course, has the most data centers out of any state in the United States. They have revised that 15-year plan just earlier this year, and they are expecting demand for their electricity production in Virginia to rise by 100% over the next 15 years. So it went from single digits to 2x. That's how quickly this has happened. I can give you 3 more examples of that. I don't need to, but across the board, we're seeing electricity demand rise. And so utilities are like, we see this, we need to react and make sure that we can fulfill that demand environment. So they're all looking at uprates and improved efficiency at their existing plants. They're all looking at life extensions. Just news yesterday that in a plant that was shut down in Iowa in 2020, they're thinking about restarting that plant. There's talks, of course, about Palisades in Michigan, which already has 1.5 billion loan offered from the federal government to restart that plant, but also talks about potentially one of the units at 3 Mile Island restarting that Constellation mentioned the other day. It's a crazy environment. It's a crazy environment that these utilities have never seen in their entire operating existence, to see this type of demand growth. So they're focused on that, and they've got plenty of incentives to grow into that demand. They're not really focused on the pricing environment. And considering the rising prices of electricity, especially in deregulated markets in the US, they're making money hand over fist. So the rising price in uranium, it matters, right? They're always wanting to optimize costs as much as possible. So when they're seeing contracts with little to no offering of fixed prices, very high ceilings, pretty high floors, they're kind of like, this doesn't really work for us. We want fixed pricing, at least partially fixed. We want to see those floors lower. If you're going to have high ceilings, you got to lower those floors. And these negotiations are still going on and on and on. But that's what they're focused on. They're not really wanting to chase the price. They're not really concerned about supply. Meanwhile, the folks who have money on the line, which would be the investors and the analysts, who their primary clientele are utilities, are telling the utilities straight to their face in these presentations, you guys, wake up. You've got to sign more contracts. Uranium is a problem. But for utilities, uranium has never been a problem. They've never gone into the market and not been filled on their request. Their entire existence has been that of abundant above ground mobile inventory. Most of the time for the past 20 years, it's been cheap, with the exception of right now in 06 to 07. Every other period of time in the last 20, 25 years, it's been abundant and cheap. So old habits die hard. And, you know, just to frame this monologue here into a single point, I don't see how this sector can avoid very large price swings. I just don't see how that's possible. Utilities, by their very nature, are not going to step up, sign contracts that are much more expensive than they've been used to, and quote unquote take one for the team in order to support the developing projects. And the developing projects inherently take longer and cost more to come online. So you have this extremely lagged period of time for developing of new assets and of brownfield assets to get that production into the market. and you have stubborn utilities. And those two things combined basically equal massive price swings and massive price troughs. That's been the history of uranium. I just don't see how that is avoided in this case either, based on the supply and demand modeling that we've done, and now based on my interpretation of how the utilities are acting and feeling at this present time. I think we're in for another big price swing, and we're already in it. I mean, we've gone from 18 bucks a pound in 2016 to 90 bucks a pound here. It's going to keep going. There's no evidence whatsoever that I've been able to find that suggests there's going to be a windfall of supply that's going to alter this price trajectory.
You touched on electricity demand, and I'm just curious. You live in the state of California, the largest state in the US with 40 million people, same population as Canada, by the way. But what is the price of electricity in California?
Well, I can't really speak to across the state. I don't actually have that data in front of me, but I can tell you on my own bill, peak rates are approaching 30 cents a kilowatt hour. It's and on average, it's about twice what the average cost of electricity is in the United States, a little bit more than twice. I think my average cost is in the low 20 something cents a kilowatt hour.
Yeah, so we in the province of Ontario, we're paying during peak hours. I think we're paying around, if I was to convert that into USD, probably 22 cents. So yeah, you're paying quite a bit more. And in the province of Quebec, which is right beside us, of course, they have cheap power in the form of hydro. I believe they're under 10 cents.
Wow.
So a big
Yeah,
range.
it's up there. It's up there. And I want to bring up our mutual contact Doomberg. He did a recent interview that I thought was very insightful, where he talked about the cost of electricity, and I think in the coming years, the cost of electricity is really going to be expressed by the true value of electricity. So even though we might complain about high electricity bills, and I'm complaining here on a relative basis, I'm paying a lot of money for electricity, but really, what is the true value of the work that energy can do? It's far, far higher than what any of us pay for it. And I think that the demand that's coming, especially from these data centers, especially the AI data centers, it's going to pinch the grid. We're going to have a situation where electricity availability is going to be a limiting factor. And how quickly that limiting factor arrives is probably going to dictate how it's dealt with. In my estimation, the further we go out on the timeline, the more embedded AI will be in everyday lives, and the necessity of AI in technological operations, kind of like the internet is now. When the internet first started, it was a novelty. How's the internet right now? It's absolutely indispensable. None of us can go a day without it. The modern world would grind to a halt without the internet. And I think that's what is going to happen with AI, where it'll become embedded into modern processes to the point where it can't be denied its energy needs. And I don't think we're there yet. Right now, perhaps energy that could be allocated towards an AI data center versus another necessary demand element, that might be up for debate. But the tech companies, and this was a statement coming from somebody, I can't remember who it was. It might have been the energy representative from the state of Georgia. But the statement was, the tech companies, they need the energy and they have the cash. And that's what we're seeing. And here's evidence of it right now. TerraPower, they're breaking ground for their Natrium reactor in Wyoming. This is a first of a kind SMR. They're not waiting for NRC approval. They're writing a check and putting some shovels in the ground. So they obviously have the construction permits from the state of Wyoming, which is very supportive of these sorts of things. But they're just going to take that financial risk that the NRC may or may not approve this in time for it to be operational by the later part of the decade, early 2030s. But either way, they're going for it. And that has, of course, Bill Gates, Microsoft money behind it. And I think that's a big, big sign as to what's to come. We could actually see tech companies circumvent the utilities. Utilities don't want to build first of a kind. They all want more nuclear. There's 30 sites in the United States with current nuclear reactors that actually are permitted to build additional reactors. And I think those are largely going to be slotted for more AP1000s. And I think we're going to hear news of new AP1000 builds before the end of the year. That's how quickly this is moving. With that said, the tech companies, they don't care about first of a kind risk. They're not necessarily going to care about the financial risk of building something that they believe is going to be beneficial for them in the future. And they're going to get started on it. They're going to get started on it soon. And if the utilities are not on board, If the NRC has not yet approved it, maybe they'll take that risk anyways. And I think that's what TerraPower is doing. Of course, that reactor does have support from the DOE with the demonstration project, but still, there's a financial risk there, but they're going for it. And I think that's a sign of what's to come.
Yeah, all very good points. And TerraPower, what's amazing about that whole story is the company's been around since 2008, so it's taken quite a few years just to get to this point. So it's going to be interesting to see how far they get along with that and whether or not it does eventually go into production. I believe I read Bill Gates has already put $1 billion of his own money into it. The other point I want to throw too is that the last nuclear reactor to be built in the U.S. was in the state of Georgia, and I believe it was over 30 years ago. And the cost was, man, I want to say was it $30 billion, you recall?
Well, the initial start construction of the Vogtle 1 and 2 were on that time frame. 3 and 4 were the reactors that were just built this century, and unit number 4 just connected to the grid, last month. So this is a really interesting situation because the anti-nuclear movement uses the Vogtle experience, 3 and 4 experience, which bankrupted Westinghouse, way over budget, way over schedule. They use this as an example of why not to build nuclear. And the state of Georgia uses this as an example of why to build nuclear. Georgia is attracting industry. They're attracting major businesses. They're growing in a massive manner. Vogtle 4 was done much faster and much cheaper than Vogtle 3. So lessons were learned from that. And there's huge lessons to be learned from this. Yes, it went way over budget. Yes, it went way over schedule. But they're still saying this, now that these are operational, this is an incredible boon for the state of Georgia to have this amount of clean energy now pushing into the grid that can fund essentially the growth of the state further. So it's a huge success story for Georgia. They went against many odds to continue this project, especially after the bankruptcy of Westinghouse, and they pushed forward and they got it done. And I think what's going to happen now is the workforce that the skilled workforce that built Vogtle 3 and 4 is now essentially available to do more of these. And we can rinse and repeat with the lessons learned from Vogtle, building new AP1000s at existing reactor sites. And I think that's what's coming for the country. We're expecting a new liftoff report from the DOE. From what I'm hearing, this new liftoff report, I don't know when it's coming out, but it's extremely bullish. There's going to be a lot of elements in there for SMRs replacing coal plants, for new AP1000 builds, and for the importance of the new demand that's coming forth, especially from data centers and AI. And all of these things are coalescing with an incredibly supportive DOE and Biden admin when it comes to nuclear. We don't think that's going to change much if the administration changes following November. If Trump ends up winning, he of course was very much pro-nuclear, not to the extent that Biden's DOE has been. This has been phenomenal and unexpected, but we don't think any of these policies that are supporting nuclear right now are going to be reversed under a different administration.
So let's talk about the uranium price. I want to examine both the spot and the term market. And the spot peaked in January of right around $100 or maybe a little bit higher. And now we're trading in the low 80s. I want to get your thoughts on why we saw this pullback. Any specific reasons?
The spot price overshot considerably from the term price. And if you look back at the history of the term and the spot price, what often happens is when the price overshoots, it'll overshoot considerably, it'll pull back down somewhere near the term price before the next leg up. And that's exactly what happened. So the price really ran up on a number of factors. One of those factors was a couple of large RFPs that came into the market last year. The first one was from PG&E early in the year for the restart or the extension of Diablo Canyon. The second was the RFP from the Koreans, which my understanding still has not been filled. That was actually retracted from the market, and they're trying to figure out how to come back to get that filled. But those two elements tightened up the market and kind of brought to light how tight the market was. Once the price started to move up, you saw the supply pull back, and we saw a mini version of that happen this last week. So when the price started to move down, this was following the nuclear fuel market conference. Price started to move down. It was on 50,000, 100,000 pound offers, very low volume. And there were a few sellers. It wasn't one big seller trying to dump pounds and bail out because they're, every time the price moves down, retail thinks that it's some reversal of the thesis, and it couldn't be further from the truth. It's just individual actors that have pounds to trade, and they trade all the time. It's nothing new. It happens every month. But 50,000 pound, 100,000 pound offer, the price moved down from 90 to 82 something on a few 100,000 pounds traded. Then once the price firmed up and some buying interest came in, the volumes were a bit larger than what was offered on the way down. And when that happened, the same folks who were selling those pounds on the way down pulled those pounds back. And so when the price is in an uptrend, if you're holding inventory, you tend to hold on to inventory, because why sell now if you can sell next week for $5 or maybe $10 higher? And that's kind of, we go through these swings of consolidation and pullbacks and lower volumes. When the price moves up, it tends to move up pretty violently because inventory pulls back, buying interest comes in. And when there's a perception of a tight market, that's even more fuel to the fire. And that's exactly what happened Q4 of last year into January of this year. Of course, we had some other developments during that period of time, and the price was moving up into January. It was at $90 a pound to start the year off. Then what happened in January, Kazatomprom came in and said, we're going to have to revise down our production targets for 2025. They didn't put out any number, but as soon as they made that statement in mid-January, the price jumped up another $15 in about a week. So that was a perception of a shortage of supply. It was a tight physical market. It was it was financials, it was utilities, it was traders, it was producers, a bunch of different actors in the spot market. And I actually think that going forward, especially considering the tepid amount of pounds that have been contracted in the term market year to date, that we are likely to see increasing volumes happening in the spot market. And I think that utilities are going to do what they can to bolster inventories with small purchases in the spot market, unless and until they can find either two things. One, better terms in the term market coming from developers, and two, a situation where their hand is forced and they have to buy at those terms. And to the extent that they can avoid a situation where their hand is forced and we have a serious kind of panic in the market, which we've yet to experience in this bull market, I think we're going to see spot market volumes increase. And it's quiet until it isn't. Last week was extremely quiet leading into Monday, still very, very quiet. And all of a sudden, 3-4 different parties come in and want to buy a bunch of pounds. And these were not financials either. These are end users. So it's very difficult to predict in the short term. The longer term is much more clear to anybody who's done a decent amount of work. And the amount of supply that's expected to come on by the end of the decade is pretty much in line with the amount that the demand is expected to increase. So we've got a full-on demand growth market now, not just a supply-constrained market.
Okay, so you mentioned that there's 3 or 4 buyers currently in the spot market. How many pounds are they looking for? Ballpark.
There were 3 or 4 that stepped in yesterday. The volumes are a little bit higher. That data is a little bit tricky to get until those transactions are actually made. But they're coming in a little bit greater in size. You're never going to see somebody show up in the spot market and try to buy 1 million pounds for next month delivery. That doesn't really happen. They'll nibble at 100,000 or 200,000 pounds at a time, and that's kind of what we're seeing.
And given that the spot price is near the $80 term price, do you think this is a floor?
It probably is. You have to take into account the existing term market, the 3-year forward, the 5-year forward pricing, which is in the 90s and low 100s for those two metrics. Those dictate kind of the forward pricing curve. So if you're a trader and you can buy incrementally 500,000 pounds in the spot market at $85, let's say, then you can hold those on and you can deliver those into as a carry trade into the midterm market 3 years down the road and make a $15 profit. Of course, you've got the cost of carrying interest rates and things like that, but it basically says that the floor is right around that term price, that printed term price, which is $77 for UXC, $80 for Trade Tech. So, and we saw exactly that. It got to 82 and buying interest showed up in larger volume.
Well, let's talk about the term price. You may mention a couple of times that there's a big gap between the bid offer spread here and between the buyers and the sellers. Maybe you can just give us some idea what the terms are being offered by the producers and what the utilities are looking for.
So generally speaking, what we're hearing, and there's a lot of there's a lot of masking of this data. The industry doesn't really like that the terms of contracts sometimes get out there. So a lot of times contracts are actually done without being disclosed at the price reporters. But UXC says that they capture 80 to 85% of the term market in terms of volume. So when they say 28.5 million pounds have been signed this year, realistically, it's probably 30 to 35. Still very, very low number for year to date. The terms, generally speaking, are market referenced majority or entirely, rather than partially fixed. Historically speaking, you'll have a partially fixed contract where the utility has some sense of financial stability and knowing what they're going to have to pay. If the utilities had their way, they would sign 100% fixed contracts. So going back previous decade, most of those contracts were partial fixed, partial spot reference. And with flex provisions, 20%, up to 20% up or down. The contracts now, what I'm hearing, largely do not have flex provisions in them. They have floors right around that term price, 70s, 80s, and they've got ceilings north of 100. We've heard of ceilings at 120, even 130. The understanding that I have is that utilities, if they want to sign a contract with 130 ceiling, they want a lower floor, because utilities believe, generally speaking, that the price this is a synthetically high price, and at some point not too far in the future, it's gonna drop. I spoke with a fuel buyer yesterday, basically believes his managers think that this is a flash in the pan, and a few years down the road, they're going to be back in the 40s and 50s. And he's basically saying, yeah, I don't think so. But that's just the way it is. So nobody wants to sign these contracts. And some of these fuel buyers, you have to remember, signed contracts at 80, 90, 100 bucks a pound in 07, and only to have that bubble pop. And of course, that was a synthetically driven, financially driven spot price spike. $134 didn't make sense in that market. There wasn't actually a structural supply deficit. It was driven up by speculators. But you did have some utilities sign contracts north of $100. What happened when it popped and when the GFC was right on the heels of this? Fell back down to 40, 45 bucks a pound in less than a year. And everybody in the industry remembers that. So, and very few of these guys, I should say, some of them are, and the person I'm mentioning that I spoke to has done this work and communicates with people that have done the work as well. These guys don't have supply and demand spreadsheets. They haven't done this future speculation. It's not their job. Their job is to shore up inventories and make sure they have fuel for their reactor and they buy when they need to buy. But if they're asked, and they are, in polls, what will the future pricing environment be? And I've been watching these polls for the past 3 years since we've been subscribed to UXC. The polls basically say the majority of utilities that answer these polls, they believe the current pricing environment at the time the poll was issued will continue going out 24 months every single time. So at 40 bucks a pound, they thought it would stay at 40 bucks a pound 2 years from then. At 60 bucks a pound, they thought it'd be 60 bucks a pound 2 years from then. And so it's not really in their best interest to try and speculate future pricing. So when they're in communication with a developer, and the developer has, let's say, a feasibility study showing that they have a certain IRR at $65 a pound uranium, yet they're having a discussion with the utility, we want $75 floors and 120 ceilings, the utility is going to say, go screw. I've seen your feasibility study. You guys are making money hand over fist. You want to de-risk your project, give us better terms. And then the developers are saying, we've got to look out for our shareholders. We just went through a decade of hell. We've been diluting shareholders. We've taken on debt. We had no attention from you when we really needed it. So now that you want these pounds, you're going to sign it on our terms. And that's what's happening right now. And as far as I can tell, that's going to continue happening until their hand is forced, and or we have abundant new supply that's going to come into the market and sell at their terms. And I don't see the second option there happening anytime soon. I think we're years away for these big projects, NextGen's Arrow, Denison's Phoenix, Xanoprom's Ramp, et cetera, et cetera. There's incremental supply starting to trickle in here, but it's not solving the supply deficit, and not by any terms. So very, very interesting, very convoluted, difficult market, but it's moving in the direction that we want it to move. And until we see evidence otherwise, we're going to continue to believe the price pressure will be to the upside. And everybody who's done the work on the supply and demand, including the UXCs and the trade techs, are saying the exact same thing, trying to tell the utilities, hey guys, don't expect the prices to drop. Just don't expect them to drop. So very interesting period of consolidation, going to continue until it doesn't. And then we're on to the next leg higher. And I think that's going to happen. It's going to happen this year. I don't know if it's next week or next month or 2 or 3 months from now. It's very, very hard to say. We're going into the slow summer months. Usually that's slow, but there's a lot of anomalies this year with the Russian ban that just happened. That actually becomes law in August. It's a very, very interesting market.
So if I was to summarize everything, especially from what we're seeing in the spot market, you essentially think that we had a breakout. Now we've had a pullback. We're going to consolidate for a period and then break out again and take out the previous highs.
Pretty much. And I think this is going to be a rinse and repeat. I think we're going to see this another 2 or 3 or 4 times for the length of this bull market, which I expect to be at least 3 to 5 years. And who really knows, based on the current electricity demand environment, literally came out of nowhere. It's a huge, huge tailwind for nuclear. Just new nuclear builds obviously take time, but I think we're going to see a run on uranium in the next few years, and it's going to be a pretty significant run. And on all of these utilities are going to have to de-risk their fleets, de-risk their inventories by bolstering them, because the demand environment has never been this good in their entire careers. And they want to make sure they can operate into that environment. So as this supply crunch becomes more clear, as the pricing environment that's currently here is digested and accepted, then we're going to see those volumes increase in the term and spot market. We're going to see the price move up.
Interesting points. I want to get your thoughts now on the equities. Man, what a range we got here. We've got Cameco is still up 25% on the year, but Kazatomprom, it's down 5%. Spot's down about 5% on the year. What's your take here of what's happening in the equity markets? Because there's a big range between all of the names.
Sure. Yeah. Well, the spot price is actually down year to date. So that's something to kind of put into context. We obviously have outperformed the spot price year to date. If we're looking at the ETFs, for example, like URNM, I believe, has still outperformed the spot price year to date by about 10%, if my calculation is correct off the top of my head. So we're doing just fine if you're considering the actual physical price of the metal. Now, I would argue that the consistent stair-stepping higher of the term price is far more important to pay attention to. But of course, that's a price that's updated once a month, and investors just need information more urgently and more frequently. So they watch the spot price, which is updated daily or intraday in some cases. So the spot price is going in wild swings, either way, outperforming that year to date, which is a very positive sign. And yeah, these things lost a bit of their, the bloom is off the rose a little bit over the last couple of weeks with the spot price falling. And, it's just the fluctuations in a very volatile market. And I think it's extremely constructive to see the entire fuel cycle up year to date, with an exception of the spot price. And that will correct itself and come in line with the rest of the fuel cycle in time. And so, the equities, generally speaking, equities are discounting mechanisms. They're trying to price in the future. With that said, we heard over the last few days that some relatively large, let's say, institutional and retail investor influencer type newsletters that are broader, not focused on uranium or commodities, exited their positions, and they tend to trade these positions and have, volatility and risk triggers that cause them to exit. Nothing really fundamental. And retail is a little bit jumpy as always. So, there's no real, as far as I can tell, there's no real explanation needed. We see the spot price down year to date, and that's a temporary phenomenon. In the meantime, the equities have a decent discount to the recent highs, 15, 20, 25% off the highs of March, and then the highs, the recent highs of May. So, yeah, decent pullback. I think it's a buying opportunity. It's looking at the RSI, the daily RSI of the major stocks in the space. Cameco is a bit of an anomaly, but I think Cameco is actually starting to trade with a bit more of a nod toward its Westinghouse business and less of a focus on its uranium business, which I think is brilliant for the company. And so they tend to be outperforming, kind of trading with a little bit of support, probably from the utility stocks. Similar kind of environment for Cameco with the Westinghouse. Westinghouse is getting phone calls off the hook. I mean, there are conversations, discussions about building AP1000s all over the world. Not to mention what I already said, which I think we're going to see new builds of AP1000s in the United States. So great for Cameco. But if you look at SPUT, if you look at the ETFs, if you look at NextGen or Denison, handful of other stocks in the space, UEC, they all tested pretty low oversold RSI over the past few days. So in my opinion, historically speaking, that's been a buying opportunity when sentiment falls, when spot falls, when the equities fall. And, you know, that's an opportunity if you have a long-term vision, which we do.
So let's move on now. I want to talk about politics, okay? And the U.S. government recently signed into law the Russian Uranium Imports Act, which bans uranium imports from Russia. But of course, the act includes a waiver, which allows U.S. utilities to continue to import uranium from Russia until Jan of 2028. And so I want to get your thoughts. What do you think of this ban, first of all? And then what do you think of the waivers? And you made mention earlier that many utilities are still trying to make sense of it all.
Sure. There's also, you know, there's a lot of issues around Russian material shipping logistics that don't even necessarily have to do with this ban and these sanctions that have been ongoing for the last 2 years, that the sanctions has just kind of like added that nail in the coffin. Utilities are not happy about this. Of course, Russia has been a wonderful partner for all global utilities for decades. They are the cheapest. They are the most efficient. They always deliver. They always deliver on time. You can make one phone call and get your uranium conversion, enrichment, and fabrication in a single phone call. It's something that utilities are not happy about. And I would argue that the near term waivers, no waivers is actually not the most important part of this story. The most important part of this story is that the material is banned across the board in just over 3 years. So that's a major significant shift. And this is something that any utility, waivers or not, for the near term deliveries, they have exposure to contracts for SWU, for enrichment from Russia, which the ban is specifically for EUP and enrichment. If they have exposure to that past 2028, they have to renege on those contracts and sign new SWU contracts with Urenco or Orano. And so, and some of the utilities have some contracts and exposure beyond 2028. In fact, a lot of them do. So what does that mean? You got to sign a contract with Urenco Orano? Fine. What are your tails looking like? 0.28, 0.32? The tails are 0.1 above what they signed these Russian contracts with 2, 3, 4, 5 years ago. Probably not 2 years ago, but let's say 3, 4, 5, 6 years ago. They're expected to be delivered upon now in the next few years. Very low tailed assays. What does that mean? Not a lot of feedstock requirement. So now that they have to sign new enrichment contracts, not only are the transactional tails in those contracts going to be much higher than the contracts they're going to have to break with Russia, but they have to provide the feedstock up front. Whereas in Russian enrichment contracts, you have what's called a kind of a reverse or return feedstock requirement. You sign that contract, you pay for the enrichment, you pay for the EUP to be delivered. The EUP is delivered to you on the US shores, and you send them back UF6. So that's different from Urenco or Orano. They want that feedstock up front. So if you have, for example, a Russian enrichment contract with a US utility that's set to be delivered in 2029, and you've got to break out of that, not only do you have to sign a new contract that Urenco or Orano at higher tails, but you got to go buy that material now. And there's no UF6. So you've got to buy conversion if you don't already have it, and you got to buy uranium. And that's what we're seeing right now. But the only thing on US utilities' minds right now is waivers. They're all in the midst of this. They're all in the headache of going through this process, submitting them to the DOE, and fingers crossed that they will receive waivers to be able to receive the material for the most near-term deliveries later this year, 2025. That's what's top of mind for US utilities. They're not talking, generally speaking, to producers about new contracts. They want to know, am I going to get my next delivery or not? That's 100% their only concern right now. With all of that said, we don't have any great insight, and nobody really does, whether or not these waivers are going to be granted, whether or not the utility is going to be able to make the case that's a national security issue, because supposedly DOE in their communications with utilities prior to this ban even being passed said these waivers are not to save you from financial pain. So if you have to renege on a contract and sign for $200 SWU, you've got to sign for $200 SWU, not my problem. But with all of that said, utilities in the United States have one of the most powerful lobbies, and it's probably likely, I'm guessing, that at least in the near term, I would say the next 12 to 18 months, we're most likely to see those near-term deliveries get waivers, because it's going to be relatively easy for utilities to plead the case that their operations could be somehow impacted. Whether or not that's true, probably not. But if they have to not receive a near-term delivery of the UP and buy spot UP, they have to pay, gosh, probably 3x what they're paying to the Russians for that delivery. So that really hurts them financially in the near term. So hopefully, I mean, honestly, I have like the devil and angel on my shoulders all the time with this, because I'm an absolute nuclear advocate. I don't want the US nuclear fleet to be severely negatively impacted by anything, really. At the same time, clearly waivers not being granted is very constructive for the prices of everything across the fuel cycle. So the investor side of me is like, okay, well, if that happens, it happens. But most likely, I think waivers are going to be granted, at least for the near-term deliveries. But even if they're granted all the way out in every single request going out to December 31st, 2027, that doesn't really matter to me that much. Why? Because the material is cut off in 2028. That's the big story. And of course, the other part of the big story is the $2.7 billion in funding that was released with the passing of this legislation. By the way, it doesn't become law for another 2 months. So April, I think it was April 11th, if I recall correctly, or April 14th, August, mid-August. The funding that is being released is in support of the fuel cycle in the United States. So we're going to see an RFP for enrichment, for EUP, coming out of the Department of Energy in the next month or two. And that RFP is going to have domestic uranium requirements. So, and my understanding is Urenco, which is foreign owned, but has a facility in the United States, will be able to respond to that RFP. I'm sure Centrus will as well. Whether or not GLE is going to respond, I don't know. But if you're going to be making, spinning up material, if you don't have UF6 on hand, you're buying uranium and domestically, and you have to buy domestic conversion as well. So this RFP for enrichment that's coming from the DOE is very bullish for uranium, especially for domestically produced uranium and domestic producers.
There's a lot to think about there if you're a fuel buyer. And then, of course, we have an election coming up in November, and God knows what's going to happen then. Or after that, we might, if we see a change in government. So the other thing I want to get your thoughts on, Justin, boy, we are touching on a lot of points here, but this is also very recent. The U.S. government just placed sanctions on the Moscow Stock Exchange, okay? And they're trying to limit the movement of USD or US dollars, which might be funding the Ukraine war. And the Russians also own a 13% stake in the Kazakh Stock Exchange, and that's where Kazatomprom trades. I know it's relatively early since this news came out, but do you have any thoughts on this and what it might mean for Kazatomprom?
Well, it's hard for me to say this quickly, but I would just say, and this is not really that high level of a take, but it's certainly not a positive for them. You know, it doesn't look good. It's things are not moving in the direction of relations between Russia and the general area improving. They're certainly not moving that direction. So with all of that said, Kazatomprom is going to be able to continue to be the biggest producer in the world for as far out into the future as we can see. Will they be able to ramp as they've said? Probably not, but I think they'll be able to have incremental production increases as the years go on. And more of that material is going to be heading east. But that's not really that big of a story. I think to the extent that China and Russia will continue to consume via contracts and joint ventures more and more future production. That's significant. But the material physically moving east is not as significant because Western consumers can buy via swaps, especially with China. And that's part of what's already been happening for years. But, every single time there's some news like this where tensions are increasing between the United States, or let's say the West in general, and Russia, it's not a great, it doesn't give you the warm and fuzzies as far as dealing with Kazakhstan, even though they've done as best a job as they can to distance themselves from Russia and not support the war effort there, which is pretty obvious that they have not. It's an ex-Soviet state. The Russians assisted Kazakhstan with the kind of attempted coup that we saw, was that a little more than 3 years ago. So there's still very, close relations between the two countries. And obviously for Kazatomprom specifically, a lot of joint ventures with Russia, especially with their new biggest project, which is the Budenovskoye 6 and 7. That's a joint venture with Rosatom, and that's kind of the bulk of their production increases. And that project is coming along very, very slowly. So it's hard for me to say based on this news, Jimmy, exactly what that means for Kazatomprom with part of the Kazakhstan stock market being owned by the Russian stock market that's getting sanctioned. But it doesn't look good. Yeah.
And I guess the other thing that comes to my mind is the fact that the West, and especially the US, is really starting to put pressure on Russia. And with all these sanctions and the ban on uranium, et cetera. But you got to wonder, what is Russia going to do to retaliate? Like, could they just wake up one day and say, you know what, we're not going to sell the US utilities any conversion or enrichment services? Is that a possibility?
It's always a possibility. That in our estimation is not going to come from 10X, the Russian enricher. It's going to have to come from, Putin, essentially. So could that happen? 100% that could happen. And I'm actually surprised it hasn't happened already, considering what the US has levied against Russia. The fact that they continue to honor those deliveries with the extreme reliance on Russia that the US utility and the US grid has. It's surprising that it hasn't already happened. But 10X is going to want to continue to be perceived globally as a reliable source of uranium. So they're not going to voluntarily break out of any of these contracts. They did issue an interesting letter last month, which essentially said the US utilities have 60 days to produce waivers. And if they don't, it's possible that 10X will have to declare force majeure on the contracts and sell that material elsewhere, or perhaps they can pause those contracts and have deliveries in the future to be renegotiated. So they certainly are. It's hard to really say what that 60-day requirement was all about, especially because it's not even a law for another 60 days from now. So for them to kind of front run the ban actually becoming law with that requirement is interesting. They're also requesting funding up front because they don't want to send this material across the sea to have it rejected and be sent back. And what they're asking for, if they have to get out of these contracts and have the ability to sell that material into the spot EUP market at prices that are probably double, maybe more than double what the contract terms were with the US utilities in previous years, maybe even triple, they stand to greatly benefit currently if they were able to do that. It's not saying that's what they want to do, just kind of reading the tea leaves with this 60-day requirement that they issued. So there's so much gray area around this. I think really the highest level take is that this material is banned in 3.5 years. What that means for new contracts with the Western enrichers entails transactional tails, big uranium requirement, and B, all of these waivers requirements, the shipping, the logistics, all of these things are just muddying up the fuel cycle for the West, especially for the United States, but generally speaking for the West as well. So it's an environment that utilities they hate. This is not a fun market for them. And so the fuel buyers have their work cut out for them, not only dealing with the waivers in the near term, but once there's clarity in whether or not those near-term deliveries will be delivered upon, then they'll be able to come back to the table for term contract negotiations. And that's going to take on a different look in my estimation over the next, let's say, 2 to 4 months. We should see an uptick in term contract negotiations coming from the United States. During all of this, and this is kind of an anecdotal thought, but during all of this, the European utilities are far more active. They're more covered, they're more engaged. They recognize that the U.S. utilities is dealing with this Russia situation and are taking their time with contracting. They can see generally the future environment a little bit more clearly. So they've been more active. Most of the conversations in the term contract market right now are happening with utilities in the European Union. So they're definitely stepping up in a bigger way.
Well, we got a lot to look forward to in the coming months. So as we wrap up, Justin, I wanted to put you on the spot now, okay? This time last year, the market took off in August and they kept going right into year end. Do you think we're going to get the same sort of price action this year?
Well, I wouldn't necessarily say I expect the price to double again. I don't think we're going to be January of next year at $180 uranium, for example. But I do think we're going to see another big move this year, and I do think it's going to breach the highs of this year, of January. I can tell you there is large buying interest that's kind of waiting in the wings right now. The South Koreans have to come back to the table. They're life extending 10 reactors and building another 3. You have the Slovaks that still have a very large RFP in the market that's been 2 months without being filled. That was up to 21 million pounds going out to 2039. You have another couple of parties that will go unnamed that have relatively near-term needs they have to get filled. There's a lot of interest that's kind of stepping back in this quiet market, waiting to see where the price is going to settle out at. But I think that the dip has been bought in the low 80s twice now. That's right, just barely above that printed term market price. We're going to see that interest step back in the market. So hard to say what happens, like I said, in the next weeks or maybe the next month or two, because we're going into that slow summer period. But because Atomprom has to come out late July, early August and message the market on their 2025 production estimations, I don't think it's going to be as big of a shock because it was pretty obvious to us that they were not going to be able to fulfill the projection that they had last August, which was 80 million pounds in 2025. I think the market at this point expects that their production is going to be flat to incrementally increase. So I don't think that it's going to be a big surprise, but that is going to be news. Perhaps the utilities still think that they're going to be producing 80 million pounds in 2025 or 6, but anybody who's kind of done the work doesn't. But that's got to come out. And then we have a lot of buying interest just kind of waiting in the wings. So might be quiet for a little bit longer here, but I expect a big move before the end of the year, probably Q3, Q4 would be my estimation. And I think that price is going to breach the previous high.
That's what I like to hear. I want to end on a positive note. Well, Justin, that was a great overview and a great update on what's happening within the sector. And if someone would like to learn more about you and the various services that you offer, where can they go?
uraniuminsider.com. We've got a couple of tiers as far as membership goes, and yeah, it's been quite the run. We've got our 5-year anniversary this coming August, and to be completely honest, Jimmy, I never would have expected to say this 5 years ago, but I think we have another 5 years. The tailwinds are just so incredible that have arrived over especially the last 24 months. To see this 180 in sentiment around nuclear is absolutely fantastic. Of course, I'm bullish on that aside from the investing prospects, but I think that the growing electricity demand has unbelievable investing opportunities. Nuclear is one of them. And we're pretty bulled up about this sector right now. And I think we've got many years to go with this bull market.
I'm going to have a link to your newsletter in the show notes. And so if anybody wants to check it out, you can go there. And are you going to have a party for your 5-year anniversary?
That's a good question. You know what? We haven't even discussed that. We really should. We really should. So I'll think about that. I'll have to come up with some ideas. Thanks for the thought.
Yeah, you can invite the uranium family. No better family than the uranium family.
That's for sure. Yeah.
All right, Justin, once again, thank you.
It's my pleasure, Jimmy.